Welcome to OpalesqueTV. Today I'm in Dallas, Texas, together with Adam Rodman from Segra Capital Management. Adam, please give us a bit of your background and tell us more about your company.
My name's Adam Rodman. I started in the finance industry in 2007, out of college, out of Amherst College. My first job was at Bank of America in their investment banking division, and it was really kind of an interesting time. It was on the back of, again, 2007, very strong markets, very strong mergers and acquisitions markets, perfect for investment bankers, very strong LBO, leveraged buyout market, and I think every young college grad who liked finance thought that they could be the next, private equity or M&A tycoon. And so I spent a little bit more than a year at Bank of America, and those 12 to 15 months were anything but what I'd expected when I first was getting started, mainly because the subprime housing bubble was bursting. And it's kind of funny that that's the environment in which I started my finance career, because the second step that I took, and by far the most formative for me, was going and working for Corriente Advisors, a Fort Worth-based hedge fund run by one of the smartest investors around, a gentleman named Mark Hart. And Mark, who ran a very successful fund from starting in 2001, but really kind of made a global name for himself in predicting the subprime crisis in the United States and profiting for it for him and for his limited partners. And he and I met under really fortunate circumstances for myself. I was at a wedding, and at the rehearsal dinner was seated with Mark and a couple of his partners, two of the senior investment professionals at Corriente at that time. And I'd been somewhat indoctrinated. I was interviewing in New York, mainly at hedge funds that were New York based, but my superiors at Bank of America and even some of the portfolio managers and senior analysts I'd been meeting at these other hedge funds were trying to convince me that the subprime crisis, the housing crisis, what would become the global financial crisis was contained. And so I thought to myself, okay, contained. Maybe I'll be all right what I'm doing. Surely I can find another hedge fund where I'd have some great opportunity. And then I found myself ready to enjoy a nice evening at this wedding, and was really surprised to find that the gentleman at Corriente had a very, very different view for where the global markets were going and what the economic trajectory of not just the United States, but of much of the world, where it was heading. And again, this was end of 2007, beginning of 2008. And so kind of at this little round table, actually down here in Dallas, I was told that Bear Stearns and Lehman would go bankrupt over the coming months, that things would not be contained, and that the next problems would lead to Europe and what would be a European sovereign crisis. And it sounds crazy, but that's exactly how it played out. And I remember leaving that dinner and that wedding saying, well, this is some really fresh thinking. And if I ever had the opportunity to interview with them, no less get a job, I'd kind of uproot myself from New York and take a chance down in Texas. And again, that was back in 2008, and I've been here since. And it played out just as those guys kind of predicted.
So Adam, tell us, what was your role at Corriente? What did you do there?
Well, I started as a junior analyst, working for Mark and the team out of investment banking in New York. And then over the years graduated into more and more senior positions as an analyst, and then ultimately as a partner and investment committee member. And that really started, I guess, probably about 3 years in 2011, I joined the investment committee. I worked very closely with Mark and a few of the other partners there on our emerging markets related investments. We were very early on in identifying some of the problems in the Chinese growth model, and my task was originally to solve that very, very difficult puzzle of how their financial system worked and really what the implications were going to be for the globe, both negative and positive. And so I stayed with Mark for a little more than 5 years, leading into 2013. But around that time, I was hitting my stride as an investor. We had very correctly identified some problems in the Chinese property market, in the banking system, and then understood how that was going to filter into places like Brazil, Australia, in many other similar places. On the flip side of the ledger, that work led to some frontier markets investing, where we are still very active, and where we were, again, very early on and contrarian in finding opportunity. But I wanted to do that on my own. And I was very fortunate, given Mark and my relationship up to that point, that he was willing to back me off the bat in doing so. So we had a very amicable split in the beginning of 2013. I launched Segra later that year with Mark's backing, and Mark acting as my anchor investor, advisory board member, and still confidant. And that took me to running my own fund.
So tell us more about Segra. What's your focus there? What do you do?
Segra is a global opportunistic fund that's focused on the emerging and what we like to call underfollowed markets or underfollowed opportunities. Depending on the decade we were in, this strategy may have been called global macro at some point, but we've differentiated it slightly in name because we take a little bit more fundamental, a more fundamental and long-term approach to what might have been traditional macro investing. Essentially, what we do at Segra is take a top-down macro or thematic approach to the global markets, finding catalysts and opportunities driven by economic divergences, industry divergences, perhaps policy divergences, whittle back several layers of the onion to try and find what we think are more mispriced and or asymmetric plays on those bigger structural shifts. For example, perhaps a traditional macro fund or other type of manager trying to play or profit from the European Central Bank's actions. And we're right now in the middle of, or not in the middle of, the start of unprecedented policy coming from the ECB in terms of them launching their own quantitative easing. And so the traditional manager might say, well, we understand that the central bank is going to increase the size of their balance sheet, essentially print a lot of money, increase liquidity, we should be short the currency. Certainly there are many managers and traders that could profit from that type of outcome and that expression in a very good way. That's not exactly what we do in our core competency at Segra. Instead, we take a step back and say, well, what are the macro fundamentals that will be impacted or that can be impacted from this policy? And as an example, in this specific case, we're very intrigued by what's happening in Ireland, because unlike continental Europe, Ireland went through quite a very significant deleveraging event on the back of the European sovereign debt crisis, mainly in 2011. They recapitalized their banks, they moved a bunch of assets, banking assets, into a bad bank vehicle called NAMA. Their property market fell 85% peak to trough. And they went through some very difficult economic times, but to a large extent deleveraged in a way that continental Europe did not. And fast forward to today, and they are growing. They have positive inflation. They have foreign investment trends that are very positive for their domestic economy. And unlike continental Europe, which is undergoing deflationary pressure, slow growth, poor demographic growth, poor investment trends, they look set to accelerate. On the other hand, or maybe most importantly though, they're still tied to the ECB's monetary policy. So we look at this very big macro lens, which maybe a lot of people would identify, and see a clear opportunity to play an economic divergence and hopefully an investment divergence stemming from one kind of macro catalyst. And what we found to be very interesting is the Irish REIT market, which was very early on. It was just started in 2013, just approved to have real estate investment trusts for the general investor. They raised significant amounts of capital, were early movers in procuring, mainly commercial real estate is where we are interested, in Ireland. which is earning very, very high returns and yield relative to what you can find in Europe. And we think the macro backdrop there is setting up for a very asymmetric opportunity, whereby the asset values are going to increase significantly based on their own merit, but also because of the yield-searching behavior that is going to be driven by the ECB's policy, the European Central Bank's policy.
So Adam, what opportunities are you offering your investors right now?
Well, Matthias, we're very excited about the current investment landscape. The last 5 years have been difficult, a difficult environment for opportunistic investors, particularly global opportunistic investors. Volatility's been low, correlations have been very high between markets, making kind of relative value guys, or guys that are trying to find fundamental differences between markets and industries, somewhat hamstrung. I think this is the opportunity, this is the kind of market in which you want to have a more open, opportunistic mandate. Segra has traditionally been focused on equity and credit investments in really the global landscape. We have a very open mandate to find the best opportunities that exist out there. And we come from a strong background of identifying those opportunities if and when we're in a market that shows, structural changes. And I think that there's good reason to be excited about the coming months, quarters, certainly years, being that type of investing landscape. The Federal Reserve, it's probably just a matter of when, not if, will be raising interest rates, data dependent, while the European Central Bank is now engaging in a new policy path, creating clear divergences. You still have Japan trying a reflationary policy. Emerging markets, which have been probably the most highly correlated over the last couple years in particular, are starting to diverge, with India's new growth mandate delivered via Modi, and on the other hand, Brazil, which is mired in slow growth and inefficiency, which means that for somebody with kind of an expertise or a history in these markets, it's starting to create an opportunity where being outside of just the United States or just Europe may very well create a better balance, both on the long and the short side. And having that flexibility, in addition to asset flexibility, is what we're really excited about now, more so than at any other time since we launched the fund.
So Adam, you have a really broad mandate, but tell us more about your actual investment process.
So even though we have a broad mandate, and it might sound complicated, we've actually narrowed it into a rather rigorous and replicatable process, which I'm very proud of. Generally, macro or opportunistic strategies have been thought of as highly discretionary. And oftentimes the pushback that we get, similar to your question, is how do you take this discretionary strategy and implement it time and time again? And in the simplest way, I explain it to people like this. We think of investments and investment opportunities as an upside-down triangle placed on top of a right-side-up triangle. And as is indicated from that, the upside-down triangle starts with a very wide base, a very wide idea. Prime Minister Modi is elected in India, or Kuroda takes over the BOJ in Japan. Is he going to change that market? And we whittle down through those layers of the upside-down triangle to come to a conclusion. Is there a security, or is there an industry, and then a security within that industry, or group of those, that reflects this macro or structural catalyst behind it? And if the answer to that is yes, then the real work begins. And we spend 70 or 75% of our investment process on that right side up triangle, which is to start with fundamental due diligence, very similar to any long-short process. Understanding the investment opportunity inside and out, but getting a structural expertise there. Similar to the way that at Corriente we went into a deep dive on subprime and how the financial institutions and mortgages were inextricably linked and were problematic and would have derivative effects on the economy, or how European financials and sovereign debt were linked and how there would be derivative effects. On the long side, how the commodities reflation of 2002 to 2007 would work, and where the leverage was in a positive way in that cycle. We are looking for big, broad structural trends on the long and the short side, and filtering it through this investment process leads us to a pretty strict checklist of when we know we have something good or not.
So Adam, tell us more about the setup of your fund, and also why are you in Texas running this global macro fundamentally based strategy? Why are you not in New York, London, or Hong Kong?
So your two questions are inextricably linked. What is our fund structure and why Texas? We've been very fortunate to have the backing of some of Texas's best managers in recent history. I've spoken a little bit about Mark Hart, my mentor, who I worked for before. We also have several very prominent former hedge fund managers backing the venture, serving on our advisory board. And they, frankly, wanted me close to home so that we could exchange ideas more frequently, stay out of the groupthink, maybe most importantly, of New York and London, to keep that independent spirit, which is kind of critical to our investment process. On a more practical side, Texas is a fantastic place to run a financial firm. The cost structure here versus a New York, London, Singapore, Hong Kong is very, very attractive. Segra runs a very tight team that we think is very operationally efficient, is the way to say it. We're 3 analysts currently, COO and CFO in-house, and then partnered with world-class service providers. So again, why Texas? I've worked in New York, lived in New York, spent a lot of time in London and Hong Kong in particular, and the cost structure and business friendliness of Texas as a whole, and maybe Dallas in particular, for a hedge fund is just extremely appealing for an emerging manager. We are able to run more efficiently and leaner as a team and from a cost perspective, which I think particularly in our early days will increase our success rate and make for an even better organization. And furthermore, we've had the opportunity to really partner with, I like to use the word partner with, some of the best in breed service providers. Goldman Sachs is our prime broker, and they've recently opened a very large office here in Dallas. We use Aiken Gump as our legal counsel, SS&C as our administrator. And so we have been able to establish, maybe unlike some other emerging managers, really a world-class infrastructure with world-class service providers for a cost that can't be achieved in a different city.